What's up, everybody, and welcome back to Bizarre Trades. As I promised before, in this video, I'm going to show you how I place my call options using Robinhood, Webull, and Thinkorswim. So we'll start with Robinhood first. This lesson is going to be very informal, and I'm going to show you how I place an options order. So the first thing is to look up the stock that you want to trade on. So I want to purchase an option of Square. Okay, now I'm going to oversimplify this process a little bit. So I'll give you a bit of a thought process here. If I'm looking at Square and and taking into account the current situation with what's going on right now, where all the stocks have dropped dramatically from their highs, I can say, and like I said, this is an oversimplification of process. But let's say I want to invest in Square. I want to buy a option of Square, and I look at they peaked at around $85 just before the market crashed. So I can say, okay, well, I think Square is going to climb back up to $85 when the market recovers. Let's just say that's my analogy, right? So I want to purchase a call option, right? I think it's going to go back up to $85. So I'll click on the trade button here, trade options. And we're going to do the same exact option purchase on all three platforms, just so that you can understand the similarities or differences between the platforms. So the first thing is choosing the expiration date. Now, as you see here, we have April 9, April 17, April 24. You have 4 weeks in April. One of them, and I believe is April 24, is the standard expiration, but the rest of them are considered weeklies. That means that they happen every week on Friday. That's when they expire. So considering the current situation and we don't know when the market is going to fully recover, I want to go a little bit further out. So let's say I'm going to give Square until January 2021 to reach the $85 target price or strike price. So I'm going to click on January 15, 2021. And if you look at the left, those are all your strike options. Now in the very middle, where it reads share price, 54,080 cents, that is the current price of share. That is the current price of Square, and that's the price that it closed at today. Since we're recording this video after market hours. So now my target or my strike price is going to be $85. Let's see if we have, there it is. So there it is, $85 call. Okay. If you look over to the right, it says that per share, this is going to cost me $2.62. So that means that for one contract option, multiply this by 100, because we're controlling 100 shares per contract, as I mentioned in the previous video. We are going to pay $262 for that contract option. So let me go back up here. Got too happy with the stylus. So we're purchasing the $85 call, for 2,062 cents a share, total $262. Now let's click on it. And I'm going to select one contract option, and you see how the maximum cost calculates the total cost of this option. It's $262. Now notice here where it reads limit price, bid $2.44 and ask $2.80. If you aren't familiar with the bid and ask prices, the ask price, put it this way: if someone holds this option in the market, they're asking you to pay them $280 to purchase it so they can sell it to you. But other people out in the market, just like you right now, who want to purchase this option, you're bidding $245. You're offering to pay $244 to the seller. So the difference between the bid and the ask price is what we refer to as the spread. This isn't a bad spread. Okay, it's about $36 different when you do the math. It's not too bad. I've seen worse where you have $200 or $300 difference, and you got to give the stock a little bit of time to catch up so that you can break even. And that's it. You select you want to purchase one option or as many contracts that you want to purchase, and click on the check mark and hit submit. Now, I don't have a lot of funds in this account. This is a small account, so I won't be submitting this at this point, obviously. And we're after market hours. Every single platform, with the exception of Thinkorswim, does not allow you to submit these orders. At least the platforms that I use. Robinhood, Webull, they don't allow you to submit orders for options after market hours. But Thinkorswim allows you to at least place the orders, and they'll be on queue until the next morning. I'll take that back. I think with Robinhood, you can submit orders after hours, and they'll be on queue until the market opens. That's correct. Webull is the only one so far that doesn't allow you to do that. So this is how you place an order to purchase a call option in Robinhood. Now, if you're curious about this, if you click on the bid and ask price and you look in here, you have something we call the Greeks. And I'm only going to explain two of them at this point. So the delta, I find it pretty low, but it grows over time as the stock price rises and you get closer to being in the money, meaning that your target price is almost being reached. The delta is going to increase. Delta here, the 22 cents or 23 cents if you round it up, this is what you earn per share every time Square change goes up by $1. So if Square, let's see, what was Square trading at? Square was trading at $54.80. So when it goes from $54.80 to $55.80, you're gonna earn 23 cents. And now that's 23 cents per share. So since you're controlling 100 shares, then you multiply that times 100. The theta, on the other hand, it does the opposite. Every day that you hold these options, you will be losing a penny or a penny and a half almost per day until expiration. And this amount increases also as you get closer to your expiration. So you got to be careful. Some options, they have a pretty heavy theta. Options like Roku or Shopify, the big ones, Tesla, especially if you're in that week in which they're about to expire, some of them can charge you over $1 per share if if the option is expiring that Friday. Also during earnings, the theta is pretty high as well. So let's move on to Webull. So now what we purchased here, just to recap, we selected the $85 call at $2.62 per share. So that's going to cost us $262. We clicked, entered one option contract, and clicked on the check mark. And that's how you enter the call option. Remember, you can sell this call option at any time if it reaches your, a value that you're comfortable selling. So if you spend $262 and it's worth $500, you can sell it. You don't have to hold the option until it expires in January 2021. You can sell it at any time. So let's move on to Webull. So we're going to place the same exact order here. So we're going to search on the upper right hand corner for Square. There it is. And at the bottom where it reads options, you're going to click on that. Now I'm going to close this here and look at the bottom where it reads, bottom left where it reads both. You can select calls right away to see only the calls, or you can have both by default. So I'm going to click on just calls, and I'm going to look for the expiration date that we selected in Robinhood, and that's 15 January 2021. I'm going to open that up, and you're going to scroll down to the $85 call, and here it is. Now the price is a little bit different here, okay, but I wouldn't worry about that at this point. These prices, it's whatever was recorded at market closing. So you have the bid and the ask price. Again, the ask price will get you in the door right away. The bid price is the highest offer being made by buyers, people who want to purchase the option. at this strike price. So you click on the ask price, okay, biometrics. And at the bottom, you can click on trade to open up for more options. So now here, you can customize, the limit price if you choose to. Okay, you can do that here. And if you're satisfied with the limit price you selected, you choose how many contracts you want to purchase. Bottom right is going to show you the total that you're going to spend, $280, and you click on buy. And like I mentioned before, we're doing this after market hours, so it doesn't allow me to submit. So now we're going to go into Thinkorswim from TD Ameritrade, and we're going to submit the same exact order. This is the paper trading account. And by default, that was already in options because I was checking them out earlier. So same setup here. We're going to close this, go all the way down to January of 2021. Scroll all the way down to the $85 call. See, this number is the same as the one we saw in Webull, 280. Click on that. Now, in TD Ameritrade, Thinkorswim, you got to be careful which one of these two you click. I don't think it's the same thing in Webull. Okay, I haven't actually gotten that when I click on them. I mean, if I click on the 246 or the 280, 246 being the bid and 280 being the ask price, when I click on either one of them in Webull, it's still a buy. Here, on the other hand, if I were to click on the bid, it initiates a sell order. So I'm selling to open a position. But if I click on the ask price, then I am buying a position. So you got to be really careful when you do this here in Thinkorswim if you're using that to trade. If you're thinking that the stock is going up, and this is just to simplify the process for you, if you think the stock is going up, you will click on the ask price. If you want to bet that it's going to drop, then you can go ahead and click on the bid. There are other things that play a role into placing this order. Like, yeah, you got to have collateral. And that means like you have to probably own the stock before you place a bid, or you can do a vertical spread where this is where you get to buy and purchase an order with the ask and the bid price at two different strike prices. But we can get into that a lot later on. But here, we're going to purchase the same exact options contract. So just lost my connection. There we go. So we're going to click on the ask price, 280. It opens up this window. We're going to adjust the quantity to 1. There it is, $280.65. That's the other thing about Thinkorswim here. Thinkorswim, I love it. And it's very effective. The execution is great, but they do charge 65 cents per contract. So you have 65 cents here appended to your total cost. And then that's it. You scroll down here, it tells you the potential that you can make with this particular purchase order, and then confirm per trade. And there you go, submit. And there it went through. Okay, so that's it. That's how you place an order when you're purchasing a call option. If you're buying a put because you think the share price is going to drop, then you follow the same exact process. Only here, you will be selecting a put. So let's say we think it's going to go down. And you see it's currently trading around $55. So we're going to place a put. So we're going to the right-hand side. And same as I said earlier, you're going to click on the ask price, not on the bid. Click on the ask price. It's a lot more that goes on into the bid, into selling, to open. So let's say I want to choose one in the money, which is the $55 call. So I select this one. Click on the ask price. Adjust the quantity. It's telling me that that position is going to cost me $1,100 plus the commission, the 65 cents per contract. Same way, if I think the square is going to drop, click to send the paper order, and there it goes. So in Webull, we will come down to the bottom here. Let's see, click on options, select puts. You can look at both of them at the same time, but if that confuses you, you can just select puts. And then you scroll to, you look for, I'm going to select the same expiration date. And we're going to select the $55 call, which is right here. So you're going to click on the ask price, 11.20, trade. You can adjust the limit price, number of contracts, and hit buy. And now if we go back to Robinhood, and Robinhood to do a put, when you come to this window again, you select put at the top right. Okay, think it's going up, hit the call button. You think it's going down, you hit the put button. And here, all you do is select the strike price of $55. It says here it's going to cost you $11.03. But now look at something interesting here. When you click on this, you're seeing here that the cost is $11.03. But when you open it up, the bid is $10.85. The ask is $11.20. The reason to this is that, so I mentioned before, this is the spread. This is the difference between the sellers and the buyers' offers, right? But the number that you see here by default, the $11.03, that's the average of the bid and the ask. So if you select one and submit that order, it doesn't necessarily mean that it will be executed right away. If the stock drops and it causes the ask price to drop to the offer that you're making of $11.03, then your order will be executed. Other than that, it might just sit there for a while until the stock drops and the option reaches your offer, or until somebody sells at market and your order gets executed. But if you want to get into the option right away, then you will adjust the limit price and you will have it match the ask price. And that way you can get in right away. I wouldn't recommend that unless, let's say, a couple of conditions are met. Like, for example, if the bid and ask price are really small, like the difference is only like maybe 5 cents, 2 cents, then it's really not that bad. You know, you're not losing as much. And the reason I say this, because if you decide to get in at $11.20, that's going to cost you $1,100. $1,120. If you suddenly change your mind, you want to sell it, the highest offer out there is for $1,085. So you are losing money as soon as you enter the position. But if the bid and ask price are a little closer to each other and you change your mind after you enter, say for example, the ask as it is now is $1,120, and then let's say the bid is $1,110. Well, there's only $10 difference that you lose if you change your mind after purchasing it and you want to sell it. So that's not going to have a huge impact. It's not a big deal. But when you have a bid and ask price like this, it can hurt. So you may want to bargain the price down and say, well, you really want to get in, but you don't want to pay, the $1,100. You can say, well, I want to increase my chances of getting in, but I'm going to place a bid at $10.90. You increase that, so your order will move up. Your order will be your bid will be bumped up in front of the $10.85 bid, and you increase your chances of your bid being picked up and you getting into the option a lot sooner. So I apologize. I know this video may sound a little confusing, but if you found this helpful, if you picked up anything, I hope you did. Let me know in the comments. I can actually go into further detail with these, but options are confusing, and the best way to learn options is by getting your hands in the game, getting your hands dirty. Open up the app, find something, one of these positions that you can play with funds that you don't mind losing. And that's really the premise of when you're investing. You can't play with money that you can't afford to lose. I had to learn this the hard way, and I don't expect you to learn it the same way I did, but at least I hope that this gives you a bit of an edge or an understanding into options trading. You can always use Thinkorswim, the paper trading app, and that's pretty good. It has all the options available. You can trade every single one of them. I think the account starts you off with about 200,000, I believe. Let me check. I haven't checked this in a while. Yeah. So just over 200,000, they start you off, and you can trade stocks, you can trade options, and you can put these little bits and pieces into practice. And the further you increase your knowledge, the better off you will be. So again, I hope this video was helpful for you. Let me know in the comments what you think, what kind of other video you'd like me to make, and leave a like, a thumbs up, thumbs down. And till next time, take care and be safe.